Morning and welcome to the Shenkman Wealth Management Accountant Attorney Spring webinar series. This program is entitled Estate Planning for Cryptocurrency and NFTs. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary. And as of this Monday, I'm also president of my newly launched independent wealth management firm, Shenkman Wealth Management. After 15 years at major Wall Street firms, I'm excited to finally hang up my own shingle. I'll be sure to include my contact information in the follow-up email to this webinar, and I welcome the opportunity to connect with everyone on this call. As I always mention, the goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One quick note before I introduce our esteemed speaker, which is the handout to this program was sent out within the reminder email yesterday morning and this morning as well. Will also be sent out again in the follow-up email to this program tomorrow morning. Today, we're privileged to hear from Lara Sass, who's the founder of Lara Sass and Associates based in New York. Lara specializes in advising high net worth clients on lifetime and post-mortem strategies to reduce gift, estate, and generation skipping transfer taxes on transfers of property, as well as trust and estate administration. Lara represents many of the wealthiest individuals and families in the country, including founders, owners of closely held businesses, corporate executives, professional athletes, entertainers, artists, real estate owners and developers, and principals at private equity firms and hedge funds. She also counsels beneficiaries, trustees, and nonprofit organizations involved in the administration of estate and trusts. Today, Lara will be speaking on estate planning for cryptocurrency and NFTs. With that introduction, I'll now turn the program over to Lara.
Jonathan, thanks so much for having me today. It's a pleasure to both participate in and attend your webinar series. And congrats on your new venture. Wishing you the best.
Thank you.
As you mentioned, today I'll be speaking about the importance of estate planning for cryptocurrency and NFTs, pretty hot topic these days. As cryptocurrencies continue to soar in adoption, advisors are likely to see more clients acquiring these assets and incorporating them into their estate plans. Many elements of traditional estate planning are rendered obsolete when it comes to crypto assets, but new strategies are constantly evolving to meet the needs of a growing number of digital asset investors in a market that's currently worth more than $1 trillion. When individuals sit down with their attorneys to discuss their estate plans, they typically think of the traditional assets first: their home, bank and brokerage accounts, retirement accounts, investments, business interests. But for an increasingly large number of people, digital assets, crypto assets in particular, are becoming just as important. Crypto assets, which include cryptocurrencies and non-currency blockchain tokens, can hold significant generational wealth and also present complex challenges to securing, transferring, and gifting that wealth. Unless you've been living under a rock for the last few years, and I sort of feel like I actually have been, chances are that you've heard the term cryptocurrency and NFT. Just in case, before I dive in, I think it's worth taking a moment to define what I mean by the term cryptocurrency. Cryptocurrency is a digital asset that is created and traded online using encryption. Miners, essentially computer operators, establish new units of a digital currency and record them on what is called a blockchain, which is a string of verified public transaction records. Cryptocurrency records are public, but the identity of the holder is actually private. Virtual money is traded on exchanges such as Coinbase, Kraken, and Crypto.com, and a transaction involves the exchange of wallet numbers, no names. There are two primary ways to own a crypto account. One is through a wallet on a cryptocurrency exchange, or two is in your own wallet with an encrypted private key. A hot wallet, as it is called, is connected to the internet and could be vulnerable to online attacks, whereas what is called a cold wallet is typically not connected to the internet and can be a more secure method of storage. For crypto accounts not held on an exchange, each account is accessible by an encrypted private key, which could be as long as 64 digits that is unique to each owner. When an owner signs up for or purchases a wallet, he or she will receive a unique key that must be entered in an exact order in order to access that wallet. There are thousands of cryptocurrencies. The most well-known ones today include Bitcoin, Ethereum, Cardano, and Dogecoin. Ever increasingly, cryptocurrencies can be used to purchase tangible items. For example, it was big news when Elon Musk announced that Tesla's supercharging station will accept Dogecoin as payment. In addition, PayPal and Venmo now allow users to buy and hold cryptocurrency in their digital wallets. While I'm at it, I just want to briefly mention and define non-fungible tokens, or NFTs, which are digital assets that are unique and cannot be divided, like a work of art or a video. That is, they are not fungible as our cryptocurrencies. NFTs are built on the same kind of programming as cryptocurrencies, however, and are typically purchased using Ethereum and are also stored in digital wallets. They are traded on various marketplaces like OpenSea. In 2021, sales of NFTs totaled $23 billion. These assets can include digital art, sports collectibles, gaming collectibles, and characters, music, video clips, social media posts, and digital real estate in the metaverse. Aside from their value in the marketplace, NFTs are also attractive because they connect individual investors to a community. If you own a Bored Ape, for example, you're in a community with Madonna, Jimmy Fallon, Justin Bieber, Paris Hilton, to name a few, and it may only cost you $350,000 plus to get there. As a quickly growing asset, NFTs should also be considered in a properly designed estate plan. Many of the techniques and tips that I'll discuss with respect to cryptocurrency in particular will apply to NFTs as well. When it comes to creating estate plans for individuals with crypto assets, it's important to understand the unique planning hurdles that surround these types of assets. A key consideration is that, unlike traditional assets, crypto assets are viewed and treated differently by the IRS. This virtual currency is not considered currency. It's considered property according to the IRS. This means that, like property, virtual currency is treated as a capital asset, and the same tax principles that are applied to property transactions are applied to crypto transactions. For example, if an individual holds cryptocurrency assets, either for personal or investment purposes, and sells that asset, they are subject to capital gains tax rules. That is, if the virtual asset was received as compensation for a good or service, or as an investment and was held for a period of less than 12 months, then it will fall under short-term capital gains rules, and ordinary income tax rates would apply. If the virtual asset was instead received as an investment and held for a period of over 12 months, then it would fall under long-term capital gains rules. For individuals who are actually in the business of trading crypto or mining crypto, their ordinary income tax rate would apply. Failure to report cryptocurrency transactions has also become a big news item. And if they're not filed on a timely filed income tax return, can lead to fines and even prison time. As a result, it's important to note that any trust that holds cryptocurrency, which wishes to liquidate these assets in order to make a distribution to a particular beneficiary, should be aware of and properly report any cap gains or losses that ensue from the liquidation. Unlike traditional assets, there is no physical manifestation of cryptocurrency. So failing to include it as part of an estate plan could be far more detrimental than neglecting to plan for traditional assets, which beneficiaries can actually see and identify. When planning an estate, it's crucial to obtain information on any crypto held by the individual and to include language in the estate planning documents that permits fiduciaries to access, retain, and manage the crypto without extraneous liability. Fiduciaries should be made aware of the existence of cryptocurrency in the estate and should inquire with the decedent's family member and advisors to determine whether the decedent owned crypto at death. Properly drafted estate planning documents will also specifically permit fiduciaries to access the decedent's digital assets, such as laptops, mobile phones, which may have information about any cryptocurrencies owned by the decedent at death. It's important to provide these powers to the fiduciaries in an estate in order to allow the fiduciaries to access the decedent's cryptocurrency at death. Even if the decedent provides the fiduciary with her cryptocurrency keys during her life, the fiduciary's use of the keys after the death of this individual without the proper permissions in the decedent's estate planning documents and related laws could cause the fiduciary to violate federal or state privacy laws, terms of service agreements, or computer fraud and data protection laws. Crypto exchanges are similar to traditional brokerages in that a custodian holds the account. Unfortunately, to date, most exchanges don't even allow for beneficiary designations or ownership by a trust or business entity, which can make traditional estate planning difficult. Another downside is that if an account does increase significantly in value, only so much can be withdrawn from the exchange on a daily basis, thereby limiting immediate access to the assets and increasing the importance of long-term planning. A probate administration, although traditionally undesirable, will hopefully ensure the account is not completely lost upon the death of the owner. For crypto accounts not held on an exchange, each account is accessible by a private key, as I had explained. If the key is lost, there is no password reset or court order in the world that could possibly recover the key. So the account and all of its value will be gone forever. You may have heard about Matthew Mellon, who is heir to the Mellon fortune, who died without passing along information on his $1 billion crypto account. Or James Howells, who mistakenly threw away a hard drive containing access to over $300 million of Bitcoin and has literally been searching landfills for years to track it down. Of the existing 18.5 million Bitcoin, around 20% or $125 billion appears to be lost or otherwise stranded in wallets. So the point is, for the crypto held by the owner alone with keys, loved ones must know, 1, that the account exists in the first place, 2, where to find it, and 3, how to access it via private key. The loss of crypto assets could be disastrous for a family's financial legacy. So to keep digital assets safe, investors must choose and execute a plan based on their holdings and circumstances. As such, there are a few estate planning techniques that I recommend to my clients to minimize the risk that a valuable crypto account is lost to theft or death. As the first measure, consider sharing the account information, including the private key, with your spouse or a trusted family member, advisor, or friend. It's critical to remember, however, when selecting the appropriate holder of this information, to treat it like cash. Access to the key itself is all the person needs to access the account, move it, and claim it as their own. If cryptocurrency assets are moved improperly, the assets may be traceable, but still completely impossible to recover. For some, it may be better to include the pertinent information, including the private key, in a memo locked away in a safe deposit box or other secure location where a trusted family member will know where to find it when the time comes. If your family members or intended beneficiaries are not familiar with the workings of crypto accounts, providing a step-by-step guide to access and administer the cryptocurrency may be advisable. As a second measure, consider splitting the private key among a few different trusted individuals. Perhaps your attorney holds half the key and your accountant the other half. but an arrangement should be entered into with both as to when and how the information is disseminated upon your death, and as to what storage mechanism each can offer. A third solution is to sprinkle the key among intended beneficiaries, but keep in mind when the time comes, they should understand how to decipher it appropriately. As an example, giving your spouse digits A, B, and C, your son D, E, and F, and your daughter GHI might seem to make sense. The issue comes along if one of them loses their key. A better solution might be to give your spouse A, B, C, and D, E, F, your son D, E, F, and GHI, and your daughter GHI and ABC. That way, two people are still required, but the loss of one of them will not be fatal to accessing the account. A fourth option includes what is called a dead man switch. Instead of including another person on a transaction, a computer acts as the third verifying party. In this instance, a program periodically sends messages asking if the cryptocurrency user is still alive. If there's no response after a specified number of tries, then the program will activate a switch and transfer the virtual coins automatically to an intended beneficiary. I do want to stress that the details regarding crypto accounts and keys should not be included in the actual estate planning documents themselves, because if they're included in a will, for instance, they could be made public in probate court. Similarly, if they're included in a trust agreement, they could be revealed to other trust beneficiaries who are not the intended recipients of them. As I explained earlier, the IRS treats crypto as property for federal tax purposes. Thus, the federal gift and estate tax rules governing property transfers, such as real estate and stocks, applies to crypto assets as well. As of 2022, the lifetime estate and gift tax exemption for individuals is $12.06 million and $24.12 million for married couples. This means that an individual can gift during life or transfer at death up to $12.06 million, again, 24.12 for married couples, to his or her heirs and pay no federal gift or estate tax on that transfer. Amounts transferred in excess of this federal exemption will be taxed at rates of up to 40%. Accordingly, if the fair market value of the cryptocurrency, along with other transferred assets, is more than 12.06 million, any amounts in excess of the exemption will be subject to federal estate tax. By contrast, the beneficiary will not be taxed on the receipt of the cryptocurrency, and her basis in the crypto assets will be stepped up to the value at the time of the decedent's death. There are a number of planning techniques that can be used to minimize estate taxes for individuals who anticipate that their crypto holdings will substantially appreciate in value during their lifetime. Despite the volatility of cryptocurrencies, given their potential for appreciation over time, it may be advisable to gift them to an irrevocable family trust for descendants as beneficiaries. If cryptocurrencies increase in value over time, the appreciated value of the cryptocurrency in the trust would pass to the grantor's descendants free of any estate or further gift taxes. In this way, greater wealth can be passed down to later generations while avoiding unnecessary death taxes that would be incurred if the cryptocurrency had not been placed in trust. A grantor retained annuity trust, or Grat, may also be a useful vehicle for cryptocurrency because of its volatility. For those not familiar with this technique, a Grat is an irrevocable trust from which the grantor retains the right to receive annuity payments. At the end of this retained term, assets contained in the trust pass to other remainder beneficiaries. The annuity payments made to the grantor during the term of the trust dramatically reduce the value of the gift made to the remainder beneficiaries when the Grat is established, so that only the net present value of the remainder interest is subject to gift tax, if any. A Grat produces estate and gift tax savings if the assets placed in the Grat produce a total net return of income and appreciation in excess of the assumed discount rate under the Internal Revenue Code. A Grat funded with cryptocurrency is relatively easy for a trustee to administer. When a Grat is funded with crypto, it's often best practice to obtain a qualified appraisal of the value of the crypto transferred to the Grat, upon which the annuity amount of the Grat will be based. If the trustee also opens up a simple bank account for the Grat at the time of funding, the trustee can use this power of substitution to exchange the cash in the bank account for cryptocurrency in the Grat that is appreciated significantly, thus locking in the increased value of the cryptocurrency in the trust. An annuity payment is made with crypto by the trustee, sending it to the grantor's public crypto address. Once the annuity amount is calculated in regular currency, the trustee will need to determine how much cryptocurrency is necessary to satisfy the annuity payment. In addition to gifting to individuals and trusts, a taxpayer can donate highly appreciated cryptocurrency directly to a charity. The charity will receive full value of the cryptocurrency, and the donor will receive a charitable income tax deduction for the full fair market value. The charity will not be subject to any capital gains tax on the appreciated value. The donor could also donate to a donor advised fund, or DAF, which accepts cryptocurrency to achieve the same result. As I noted earlier, the IRS's current position treats cryptocurrency as property. Therefore, gifts of crypto should be treated for tax purposes as gifts of property, in which the donee receives the donor's cost basis in the property. As a result, when making a gift of cryptocurrency, it's important to properly track the basis of the gift. According to the IRS, a taxpayer's basis in cryptocurrency that the taxpayer receives for goods and services is equal to the fair market value of the crypto on the date the taxpayer received it. Because the IRS treats crypto as property, it's important that the basis of crypto be properly documented. Supporting documentation needs to be provided to the donee and also the fair market value of the crypto on the transfer date. The donor also needs to document the fair market value if the gift tax return is necessary. It should be noted that it can be difficult to determine the fair market value of cryptocurrency. If the cryptocurrency listed on an exchange is valued according to market supply and demand, and then converted into US dollars at the exchange rate, the crypto seems easy to value. However, the IRS requires calculation of fair market value, quote, in a reasonable manner that is consistently applied. This differs from stock on the stock exchange, for example, because the same cryptocurrency can have different values on different exchanges at the same exact time. So valuation may require an appraisal in some situations. The value of cryptocurrency for purposes of calculating a gift would be the price at which the property would change hands between a willing buyer and a willing seller on the date of the transfer. Best practices for determining the value of the cryptocurrency include taking a weighted average of the mean between the highest and lowest cryptocurrency prices from multiple cryptocurrency exchanges. Because cryptocurrency is not formally titled, the donor should consider executing a gift memorandum contemporaneously with the gift for the records of both the donor and the donee. If possible, it's best to have the donee also execute the memo or a receipt for the donor's records. The memo should detail all of the relevant information, including a description of the gift, the type and amount of the cryptocurrency, the date of the transaction, the fair market value of the gift, the donor's basis in the gift, and a statement that the donor has transferred ownership. If the gift is a charitable donation, then the memo should include language stating that the gift meets charitable deduction requirements. When a crypto owner passes away and crypto assets become part of an estate administration, these assets have at least one procedural advantage over other financial assets. Unlike a traditional bank or broker, which typically requires executors produce an original death certificate and letters testamentary received by the court following probate, in order to take control of assets in a deceased owner's estate, crypto merely requires the fiduciary to have the decedent's keys to access and transfer the account for estate administration purposes. The fiduciary then would hold the keys needed to access, invest, and distribute the assets to the beneficiaries as needed and as permitted by the relevant estate planning document. Because cryptocurrency offers ease of administration, there are fewer checks on a fiduciary who is handling a crypto account. Individuals who own crypto or have a trust that owns crypto should be exceptionally cautious when selecting an executor or trustee, because the fiduciary could use the keys to access and manage the crypto account, unlike a traditional bank account, which provides more oversight. In addition, should the fiduciary make a transfer of crypto that is not authorized by the relevant estate planning document, the transfer could be traced, but impossible to recover. As part of proper estate planning, it should be discussed with the attorney ownership of the account by your irrevocable trust or will at death. Within the trust or will, the instrument should specify the disposition of cryptocurrency. Should the account be transferred in kind to the beneficiaries or sold? Can the trustee or executor hold a concentrated position in cryptocurrency, or will the account default to diversification rules? Careful consideration must also be given, as I said, to who will serve in this capacity. Currently, many corporate trustees have policies against administering trusts with crypto or require the immediate liquidation of the crypto accounts. So an experienced individual trustee, whether only for the crypto accounts or all trust assets, may be necessary. In addition to including specific language in the revocable trust or will, an individual's power of attorney should authorize a fiduciary agent to access the individual's crypto accounts in the event of his incapacity. All of this said, cryptocurrency accounts and estate planning techniques will all likely adapt and change rapidly in the coming years. So it's important to discuss options with an experienced estate planning attorney. A crypto investor should make sure that he or she discusses strategies that are appropriate to his or her individual objectives and create or modify estate planning documents to properly address the transfer and administration of these unique assets. If anyone has any questions for me following this presentation, please feel free to reach out and I'll be happy to respond. Jonathan, thank you again so much for having me.
Thank you so much, Lara, for that enlightening presentation. I'll be sure to include Lara's contact information in the follow-up email to this program. If anyone's any business opportunities or any other issues they'd like to discuss, please feel free to reach out to Lara or myself where appropriate. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on Thursday, May 19th, and is entitled The Gift of Qualified Small Business Stock, Section 1202, featuring Andrew Katzenberg of counsel at DLA Piper, based in New York. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.